This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello everyone, Grace Ormsby here. Welcome back to a brand new episode of the Smart Property Investment Show. And it's been a pretty interesting start to the year, to say the least, about the economic environment that we do find ourselves in. And there's plenty of property investors out there, I'm sure, who aren't really sure what the next step will be with the Reserve Bank of Australia over the next month or so, choosing what it does with rates. We've obviously seen some quite interesting data trickle through from the Australian Bureau of Statistics lately, and we need to be unpacking it all. So it is an absolute pleasure to be chatting with someone who's spent quite a lot of time in the credit and investment space across commercial and residential lending. She is a mortgage broker with Finni. Sharon, welcome to the show.
Thank you very much, Grace. Thanks for inviting me.
Thank you so much. I feel like it is going to be a really, really great chat today around CPI.
Yeah, inflation. Yes.
Inflation. I mean, it has been something that people have been talking about for so long now, but it's kind of coming to a head now. We've seen the really, really high inflation rates. We've seen it kind of curbing back down, but we're not out of the woods yet. And obviously the latest data is painting quite an interesting picture at this point in time.
Indeed. I suppose, we all heard about the March inflation data came in with less encouraging results, I would say, like less ideal. So it is sort of still, it's came in a little bit higher than expected. So that sort of pushed the talks that where the rate cut will be happening imminently with RBA decision, which sort of pushed back the timeline a little bit, even that with a potential talk that potentially there will be even more rate rise. So that's definitely put people on the toes a little bit. Yes. Yeah.
So what is it that's really pushed this back up? Why have we not gone back towards that target again? What has really instigated this?
Well, if you're going to investigate the data a little bit closer, I suppose, we still see quite high in rent. I suppose that there's from memory, there's a few categories that really still push the inflation sort of high, which is the rent and the education piece. So more around, from what I can understand, is that the discretionary spending is sort of coming down, but the service sort of expenses costs is still sort of really traveling sort of higher than expected.
And it has, as you said before, there's been a lot of people that were anticipating a rate cut would come sooner rather than later. Beginning of the year, a lot of people were very optimistic that this would happen. A lot of people did race out and buy property expecting rates to come down pretty soon. Doesn't look like that's the case now. What's going on then with the sentiment following on from this result?
Well, yes, look, the property market, I have to say, if we look at the most recent clearance rate, I have to say it's still sort of relatively high. And I suppose that's because my understanding that still the supply is undersupply with the high demand. Do I see that with the inflation that the RBA potentially going to pause on or delay the rate cut or will delay some sort of people that get into the property market? I think so, it will. But I believe the seasonal property investors will still be interested to buy. And you still will see a lot of activity, especially around investment that will that happening. And what we see right now is we still see a lot of interest rate purchase happening, and there's a spike, especially in buying purchase property in the super fund, which that correlates. I'm not sure if people have read our most recent article that published on ASR that, when the normal property investor tap out the borrowing power where they can potentially look at a super fund and to buy. we see a spike in that space. Yes.
Yeah, cool. Because obviously the property market, while it does have its ups and downs and sentiment does change, there is still going to be a core group of people who, one, already have a mortgage and are having to potentially deal with a higher rate environment coming down the track. And two, those people that are looking to, maybe it's to get into their first home, or maybe it is to add to their property portfolio. As you said, that's when this spike does seem to happen. So I'm sure you are the expert here. I'm sure there's plenty that people can be doing at this point in time to put themselves in the best position. But we're going to take a quick break there. We'll come back with some of your tips, Sharon, just after the break. See you soon.
Are you looking to invest for a big return, but are unsure which suburb is up and coming and guaranteed to give you the most bang for your buck? Smart Property Investment and Pure Property Investment have unveiled the Fast 50 report for 2025, identifying the suburbs backed by research that are giving investors the highest returns. Don't make any investing decisions until you read the free report. Visit smartpropertyinvestment.com.au to download the report.
Welcome back to this episode of the Smart Property Investment Show. I am joined by Sharon Scher, who is a mortgage broker with Finni, an expert in both residential and commercial lending, has been doing it for a long time. Sharon, you would have seen a few peaks and troughs of the market over the years.
Oh, definitely. Look, and I suppose Australian property market is quite resilient, and we've seen how it's sort of like going through the tough time, and that's why, as sort of mentioned earlier, that do I really see that the sentiment that people got going to the property market will slow down? I suppose with the inflation, sort of the news that came out will deter some people, but again, I still believe that there's many activities going on. But again, look, we definitely can take sort of precaution measurements to sort of help you to combat the potential rate rise if that's on card. I've seen some of the increase of the inquiries in terms of fixed rate. We haven't seen a lot of fixed rate inquiries in the last 1 or 2 years, but these days we have had some of the inquiries asking for fixed rate, and I would suggest, look, if it's reasonable 1 year or 2 years fixed rate, I would definitely recommend to look into that option as well, additionally to the variable rates. Yes.
Interesting, because there's been a lot of talk about how variable rate, of late is the better deal, but does that mean that we could be seeing higher cash rate for longer, Sharon?
So with what lenders recently done is they have actually cut their fixed rate because of the previous prediction as the rate will come down. But whether lenders will react quickly to what's the data being released recently, I don't know. I can't predict that. But right now, the fixed rate is quite competitive. Yes, that's something you're willing to consider. With the cash rate, again, look, we want to, it's really, really hard to predict. It depends on a lot of attributes in terms of, the CPI, the employment rate, and that data, yeah.
So what then are the benefits of going down the fixed rate route compared to variable?
Look, fixed rate definitely give you the certainty of the repayments. So you definitely know how much. So it's a lot easier for you to work on your budget and your cash flow for the next fixed amount. Depends on how long you want to fix it for. But the downside is obviously that, if you intend to break your fixed term, that will incur cost. And as well as if hypothetically speaking, if the rate is going to come down, your fixed rate is not going to move until the fixed term is finished. So there's upside and a downside. Again, look, I would suggest you look at a comparison and to work out what's best for you.
Okay. What else can people be doing beyond just, choosing or looking to consider a fixed rate? I feel like there's a few more things people can be doing at this point in time.
Definitely. And I would always suggest, look, always building a buffer to your cash flow, no matter what. And then when you look at your monthly repayments, always sort of like, adding a buffer to it. So you know that in a case that whether the rate will go up, you still have a sufficient cash flow to cover that. The next things we probably have been discussed in the past for a long time, that if you lock in the rate prison, that's where you sort of feel like you can't move anywhere, where because of your borrowing capacity, I'll say, look, there's still lenders out there that are willing to consider on the exception basis. What they really means is it will reduce the buffer rate as normally 3% to 1% when considered if you are eligible borrowers. So to help you to refinance from your current lenders. But typically for those to be considered under the refinance exception, the cash out is not allowed.
Okay, so there's still options there for people, and I would encourage anyone who doesn't feel like they've got any movement or room to move with what they're doing, go chat to an expert, someone like Sharon who knows what's going on in the space. But it is an interesting time. I'd love to sort of unpack that a little bit, and I think we've talked previously on this show about it. Those, maybe the cashback, but also the streamlining of those refinance exceptions. Is that because it is so competitive still at the moment to take out a mortgage because there's so many players out there in the space?
Well, yes. Well, look, I suppose we sort of like, have seen many of the fixed rates sort of roll off, which, coming from a 1.99 or even 2% to now variable, we're probably looking at the low 6 to even high 6. So the repayments, the change in the repayments is huge. And to be able to, then a lot of people are unprepared that's coming. Mm-hmm. So some lenders willing to take into that consideration as, look, understand your, and plus, then you add 3% buffer onto it. So the borrowing power is a bit constrained when you look at it 3 years ago.
And
that's why. Yeah, sorry. Yeah.
There you go. And one thing you mentioned about having a buffer in your cash flow, I feel like that's also a really, really important point that I want to re-emphasize for people out there. What should that buffer look like? Is there a rule of thumb as to how much money you should have in reserve, always up to the side, or is there an ideal target that people can be working towards at this point in time?
Look, I always say, look, just count for extra, say, 0.5 or even a bit higher, like 1% of the extra of the interest rate if it's going to go up, and then what would be the extra repayments going to look like, and that having that putting in your offset account. I mean, once you have your mortgage, if it's a variable, then ideally you're putting your offset account or your savings account. And also when you build, work out your budget, make sure that you include the property ongoing cost as well. Mm. And sometimes people, what I found is the little things adding up, your council rates, your water rates, your strata, your property management fees. So that little extra, and sometimes, your house needs the roof needs to be replaced. If that's the case, or some cleaning, that repairs that going on, all these things will add up, which when you're looking at it to buy an investment property, typically that needs to be taken into consideration.
All good things to think about. And I guess it's probably a pretty easy calculation for people, Sharon, to be calculating what an extra 0.5% or 1% to their rate could look like on what their mortgage repayments are.
Yeah, definitely. Yes. And also look, and I suppose when you're really looking for the property, always ask upfront is how much the detail, like, the council rates or the stratas if you're buying in a townhouse. So that one needs to be taken into consideration when you think about whether do you have an ample, cash reserve to sort of able to support the ongoing expenses. Yes.
There you go. We're going to take another quick break, but don't go away. Plenty more still to come from Sharon Share. See you soon.
Ready to supercharge your mornings while supporting work which improves the lives of Aussie heroes? This June, Invictus Australia is challenging everyone to rise at 6 a.m. and get active for 6 days by taking part in their 0600 challenge. Conquer your morning however you choose, a run, swim, or a group fitness class. Whatever gets you active and connected. Empower others to support your challenge and fundraise to help strengthen the lives of our Aussie heroes through sport. And help Invictus Australia combat the statistic that we lose 6 veterans to suicide a month. So what are you waiting for? Visit www.0600.com.au to sign up today and join the 0600 community.
Hey everyone, welcome back to this episode of the Smart Property Investment Show. We are joined by Finni mortgage broker Sharon Share, who is giving some insight into what people can really be doing to, I don't want to say weather the storm, but prepare just in case the Reserve Bank of Australia does decide to continue lifting the cash rate off the back of some pretty high, less than ideal CPI data. So inflationary pressure is still very much at the forefront of Australia's economic environment at the moment, and something that we all need to be paying attention to. We wish we had a crystal ball, Sharon, and could tell people what was going on about cash rates, but we don't know. But based on all the data, there is definitely the potential that we're not out of the woods when it comes to cash rate rises.
No, not as yet. And I suppose, all we can do is to do our work and research and preparation. So we would be ready if there's still, we can't see the light of the tunnel as yet. So be prepared. And it's sort of like the other thing I touched on the refinance as well as, I suppose, we're talking about 6 to 12 months ago, a lot of lenders are offering cashback, we understand that many lenders have closed the door on a cashback, which is cash incentives for people that to refinance. But there's still some lenders out there are still offering the cash incentives for eligible borrowers, where you can potentially get to up to 2,000. So what it really helps is to cover your refinancing cost. So whenever you refinance, there's some sort of costs will be associated as typically that's a discharge fees, which is probably like a $350 to your current lender that you need to pay, and mortgage registration and deregistration fees, which is collected by the land revenue. So that's what the lenders chose to do, is to give you some sort of cash incentive to compensate for the costs that will be associated. So there's still some selective lenders will offer that, so don't miss out.
It is an enticing offer, and I guess it comes back, Sharon, to the need to build up that cash buffer, and that probably is one way to do it, I'm guessing.
Yeah. And the other thing, look, I suppose for all the seasonal property investors, you probably noticed that, when you looking at the property, you look at the two sides is the capital growth, obviously. The second is the rental yield. Again, not an expert on the property myself, but, I would just suggest that, if you come to really looking for the properties right now and the cash flow is something that you'll be taking into consideration, yes, I would suggest to be very selective and choose the high rental yield property to sort of offset the rate rise. If that's going to be happening. Yes.
How do you work with people? I'm curious, Sharon, how does it work when people come to you and they're like, I've seen this property and I think it looks great. I need help with financing for me to be able to get a loan for this property. Does the rental yield come into those conversations that you are having?
Definitely. Look, I suppose, as a mortgage broker, it's very important for us to understand the priorities, objectives, and requirements of the clients, as to really ask the questions as what do you want? What is you looking for to like, or in terms of what financial goal you want to achieve as well. So that sort of help us to able to provide that's a direction as we're able to provide and help out map out the structure for them. And comes down into the latest options, the products, as well as the potential, the structure. Yes, correct.
Are you seeing more new loan applications or refinances at the moment?
Well, as probably mentioned earlier, that we will still see a lot of investment, like a purchase going on, especially my side. I really sort of specializing in the investment space. A lot of interstate purchasers are buying properties. Typically, what I see right now is happening in Perth and in Queensland. Not so much as in South Australia, but there's still a lot of activities going on. Again, I see more and more people are, you probably heard of the term, the rent investing, as they, so that helps. I suppose the mentality is you need to start from somewhere. And right now what we see is Sydney and Melbourne market is getting very, like, it has been always high. And to save the deposit to really get into the market can be challenging for some people. So looking into some other area in the suburbs with potential capital growth and more affordable price is more and more attractive.
And I know, again, I've already mentioned that we are crystal ball gazing. We don't know what will happen with rates down the track, but a little bit longer term, Sharon, say 12 months down the track, 18 months down the track, where do you see rates going?
Personally, I do believe the rates will come down, but maybe not in the sort of time frame we would like to. Like, I suppose, if that's unfortunate, if the RBA decides to sort of push more rates up, I'm concerned there will be more distressed sales. People will be struggling with their mortgage repayments, considering that, if you're coming off from 2% to that's tripled to 6%, even higher, then it will really put some people in a very distressful position. And I'm worried that then once that's happening, then RBA will need to sort of react to that situation quickly. Then they will sort of reduce the rates a lot more than what they initially, like normally they 0.25%. So I suppose in the long sort of 12 months or onward, my personal view is it will coming down. And knowing that the property market was quite resilient as right now. So when the rates sort of start coming down, I'll be expecting that property market will sort of coming up. And that's always been the cycle. And then so we're just going through that cycle, yeah.
Well, there you go. Thank you so much, Sharon, for sharing your insights with us, your knowledge gleaned over plenty of years in the space to have a look at what is going on now, what could be happening down the track. And obviously we'll keep these conversations coming because, as we have mentioned a few times now, we don't know what is going to happen. So each time the Reserve Bank does meet, we will keep you informed as best we can. So thank you so much for your time today, Sharon.
Thank you very much, Grace. Lovely chat.
To everyone who is listening along, we hope you have enjoyed this episode. Like or review us on whatever platform that you do listen to the Smart Property Investment Show on. Check us out on our website. Subscribe to our bulletin if you have not already. And make sure you're looking for all the latest on our social media, Facebook, Twitter, LinkedIn, and Instagram. Until next time, stay safe and well wherever you're listening from. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Feeling trapped by rising interest payments? Escape from mortgage prison with expert refinancing assistance from Finni. We have helped hundreds of borrowers break free from higher loan repayments by finding a more suitable loan. Our expert team can quickly assess your situation, and if there's a better lender available, we'll find it fast. Don't delay. Call today. Speak to a Finni mortgage specialist on 02 8866 2444 or visit our website at www.finni.com.au.